by my illustrious, by my illustrious colleague and Chief Investment Officer and co-founder, Andrew. Hi, Andrew.
Morning, everybody. Morning, Sam.
And so, folks, what we're going to do is I've got a presentation that we actually do around the country about investing in tough times, but I think it's really important that we start this call just talking about the markets generally and what's happening, particularly with regards to interest rates, and just to give a sort of a view about the context that we're in right now, what has happened. And, you know, we don't make predictions about financial markets because financial markets are unpredictable, but just to give you some general themes about think about what might happen out there and how that might impact you. So, Andrew, could we just move on to you because you're the expert here, mate? What has been happening in the interest rate markets recently, and what can we take from that in terms of trying to make sensible decisions about how to manage our lives going forward?
Sure, I'll try and address that as best I can. And interestingly, we've got a question from Neil already, which is, what are your views on bonds? Given that inflation is here, how do you see this impacting bonds? Which is a really good question and is very much front of mind, particularly for the boring old guys that run bond funds. Interest rates have rose very sharply from about September last year all the way through to February. And since then, we've been going up and down a bit. More recently, yields have gone up a little. And obviously, the news that the Reserve Bank were not putting interest rates up at this stage a couple of days ago came as a bit of a surprise, but in the context of the lockdown, the sudden lockdown, I think you've got to understand that they didn't want to be seen to be doing something that was going to be, in most people's minds, negative for their personal circumstances right at the time when suddenly we were going into a lockdown. But that's really just a deferral. The next meeting is at the beginning of October, and the strongest likelihood, depending on how things go over the next few weeks, the strongest likelihood is that they will put the official cash rate up at least 0.25. And the market expectation is there's quite a lot more of that to come over the course of the next 18 months. That's already very much, we call it priced in. It's already reflected in interest rates as they stand. So at the moment, long-term government bonds are already at 1.75%. And if you go a bit longer than that, they're over 2%. So the market is anticipating that interest rates, short-term interest rates, will go up over time. So really, if it just carries on with that sort of track where we get a few small rises over the course of the next 6 to 18 months, bonds are likely to be reasonably stable. That's all reflected in the market as it stands. What would change things is if there is a change in circumstances, and that's where our view as an entity is that we can't predict that. The whole point is that the market is reflecting the most likely outcome right now, and we don't know. We can't predict the future. But assuming that things pan out as they appear at the moment, you are now getting at least, let's say, 1.75%, 2% for investing your money in bonds, which is an awful lot more than you were getting at the worst of things back when it was below 1%, back in September last year. So whether bonds represent a good investment or not for the long term, in our view, the best way is to diversify and have an investment in a number of different assets. And so bonds on their own probably are not really where you want to be, unless you want something very, very stable. And long-term yields, the sort of things that we invest in, they do swing around. So you do get some changes in the capital value, but you do eventually get the return. That's all a bit nondescript, actually, Sam.
Yeah, no, so thank you, Andrew. Andrew is always much more diplomatic than I am about these things. I think effectively one of the other messages there is do not listen to the economists when it comes to interest rate directions. It is because they're paid to think very short term in this regard. They're paid to think about the next thing the Reserve Bank will do, but as investors and as people who've got mortgages and so on, we have a very long-term view. And I'll get on in my presentation and talk about why there are still powerful deflationary forces in the market. And even though the short-term noise is about interest rates rising and people panicking and house prices falling, the long-term trend is still firmly in favor of having interest rates, regardless of whether they move up or down, in the short to medium term, being long-term under control. And I think, that would be our view there, Andrew, right? It doesn't sort of matter what happens short-term. You can't control it. It's other people's decisions. Most importantly is, we're just New Zealand. We're an island, but we're a connected island, globally connected island. And one of the interesting observations, isn't it, that we're completely against what the rest of the world's doing right now, yeah?
Oh, totally. We're the only developed country, for lack of a better word, that's predicting interest rate rises at all until towards the end of next year, I think, is the US.
Okay. So thanks, Andrew. What I'm going to do now is go into share screen, and then I will share a presentation. I'm going to go through it fairly quickly with you and just really focus on the salient points about investing in these markets and the forces that are changing them. And then we'll get on to an extended Q&A. I can already see there are 21 questions there. You can get into the chat screen and ask questions, into Q&A, raise your hands. There'll be heaps of questions. So I'll get through this pretty quickly so that we can focus on the things that you're interested in. And we tend to have like a last person standing thing on the questions. We'll carry on going for as long as we can till our voices run out or whatever. And so please obviously come and go as you feel. So just get into share screen right now, and I'll just share with you a roadshow that we that I basically take around the country. And I'll flick through some things pretty quickly on this one. Most of you will be Simplicity members on the call, and thank you very much for that. The reason I show you this one is really to focus on why we're in business, is to give people dignity in their retirement, their first home. How you do that is give people choices, and it's really focusing on what this last thing is. We're really about making people more money. Money gives you choices, choices gives you dignity. And it's a very long-term perspective. I think what you will hopefully get from Simplicity is a long-term perspective, because as many of you will know, we are a non-profit business. We're owned by a charity, and we give 15% of the fees you pay to that charity. That's now almost $140,000 a month. So it's increasing really quickly, which is great. We do Kiwisaver funds, investment funds, and mortgages, and in all of those areas we're the lowest cost provider because we're a non-profit. But the really important thing here is that this is a business which will never be worth anything because it's non-profit. That means it will never be bought or sold, and that means it will be around for 100 years. It's what we call an infinite company. And that means that the investment perspective we have tends to be much longer term. That is how most people invest, and people invest and borrow long term. And having that long-term view allows us to get rid of a lot of the noise in the market and focus on the big themes. Just to give you an update here, we're almost at 70,000 members now. With the default provider status, we'll certainly be well over 100,000 members by the end of this year, which is great. Now saving people, actually it's over $27 million now a year, which is about $390 per person on average in fee savings. And we've just hit a lovely milestone for us, $2.5 million in charitable donations in our first 5 years. And now we're managing $3.6 billion worth of funds. So things are going well. Just to show you how well we're doing, actually, this is 1 month out, but it's approximately the same for the last month. We're tracking very well, consistently in the top 15% of our competitors. You'll notice that our fee differential there means our conservative funds are right at the top of the pile now. And our balanced and growth funds are grinding up there as the fee savings continue to compound up and stay in your account. So performance is going very well. I just flick through these things as well. Let's focus now on the markets. So I just wanted to give you some perspective about this right now. As you can see there, this is the history of the 100-year history of the United States stock market in that blue line. And those gray bars there, they are recessions. And I think there's a couple of lessons here. When I give these town hall presentations, I ask people a question, what does that chart tell you? And the first thing they say is investment markets go up. And as a general rule, yes, they do. The trend is your friend long term. There are some huge moves around there, and sometimes some very long periods where markets pretty consistently go down, like in the Great Recession of the 1970s. But overall, if you believe in human endeavor, if you believe that people get up and want to make a better life and start up companies and make profit and employ people, the trend in the financial markets over the long term will continue to go up. But what's fascinating about this chart to me is two things. Look at that coronavirus blip in the context of history. it sounded really noisy and it sounded really dramatic this time last year. There were some crazy statements in the papers about it being the biggest fall in the Dow Jones ever in history. And I'll show you how they made that statement, why it was technically correct, but gave completely the wrong impression. But in the context of history, coronavirus was certainly noticeable, but not that big a deal. The other interesting thing is look at those gray bars. I mean, those are the global recessions. And let me ask you a question. Do you know when the next one is? We don't know when the next one is, right? Financial markets are inherently unpredictable, and you're crazy to try and invest predicting what the future will be. If you have a look at that period before coronavirus, see that gray bar there right over on the right-hand side, that recession, that period of white before that was quite long in the context of history. So you would say we were almost due a recession. The problem is, who knew what would cause that? I mean, I don't know if anyone predicted coronavirus. I certainly didn't. Closest thing I know, I think, is Bill Gates predicted it, but he just couldn't predict when, right? So when will the next recession be? We don't know. What will the financial markets be? We don't know. But what this tells you is that if you stay invested, you do have a very, very powerful trend, which is human beings want to improve their lives and their circumstances working in your favor. So I think that's the first thing in the context. The second thing about this chart is fascinating. If you have a look at the right-hand side, that coronavirus dip there, you'll see that the market went down from, let's call it from 30,000 down to about 22,000, about an 8,000 point drop. Now that's 8,000 points, right? And so, but 8,000 as a numerator and 30,000 as a denominator means it was about a 25% drop. But it was 8,000 points. Keep that in your mind. Go right back to the Great Depression there, and you'll see that the market went from a little over 5,000 right down to 1,000. So that was only a 4,000 point drop, right? But the 4,000 points was actually an 80% drop in the markets. But I can distinctly remember the newspaper headline a year ago saying biggest drop in Dow Jones in history. And technically it was an 8,000 point drop. But of course, 8,000 as a percentage of 30,000 is way smaller than 4,000 as a percentage of 5,000 in the Great Depression. And this is just a salient lesson here, which is don't panic and don't pay too much attention to what you read in the press, because their business is to generate headlines and to get you reading and to get your attention. How they do that is by giving you dramatic headlines. I think about a year ago, Andrew, as I can recall, we were saying, don't panic, don't panic, don't panic. In the context of history, this is not a bigger deal as it seems. That seems to have panned out. So, and if you're a long-term investor, what are you going to do? Are you going to sell at the top and buy at the bottom? A lot of people talk about that. A few pretend they can. In our experience, very few, probably nobody can. So, in the historical context of what we're going through is a salient lesson for the future. Here's the other interesting thing. This is a chart about national debt levels globally as a percentage of GDP, because the other big noise in the market is everybody's borrowed too much. This debt is unsustainable. Well, have a look at it. If it's in dark red there, like the United States, Canada, most of Europe, Japan, they've borrowed more than 100% of their GDP as in general government gross debt. In fact, in Japan, it's over 250% now. So it's absolutely huge. But the issue, and down in New Zealand and Australia, it doesn't look so bad. We're sort of in the 50 to 75% range. Now, the issue there is that is just one piece of information. A piece of information by itself is dangerous. Just a little bit of information is a dangerous thing. Because in the context of debt, if you think about having a mortgage, the issue is not only how much you borrow, but also the interest rate you're paying. So how affordable is it? Have a look at this in the New Zealand context. This is what the New Zealand government pays to borrow money. So this is the 10-year bond yield or long-term interest rate cost for the government. Back in 2001, the government were paying 7%. So they issued government bonds issuing with a 7% interest on it. Andrew, do you remember way back, what would the highest have been back in the 70s? Would we be talking?
I think it was up close to 20%.
Yeah, 20%, right. So it was 7, and it's been going down and down and down and down over time. It blipped up during COVID, you'll see right there to 1.7, and then as Andrew has said, it's subsequently gone down. In fact, since we did this chart, it's gone down even further. So the issue there is that you have a pretty powerful trend there of interest rates falling. And, ask in the town halls, what is the reason for that? And I say, look, you've got the answer in your pocket there. And everyone goes, what's that all about? And I say, look, it's your smartphone. Technology is a powerful deflationary force long term. Right back to when they invented the wheel and you could carry 30 sacks of corn to market instead of one sack on your back, right? That was the first, an early example of technology lowering the cost of doing business. And you've had it with the steam engine, electricity, light bulbs, hydraulics, computers, all these things over time, and most importantly, computers and smartphones now have been a powerful deflationary force. The long-term trend of interest rates since 1300, when the Bank of England started recording these things, has actually been down. Now, there's some huge swings, huge inflationary spikes, but the powerful trend is that interests go down and stay down. And in the context of New Zealand, and Andrew's the expert on this, have a look at what the Reserve Bank Act has done for inflation rates in New Zealand. Wildly unpredictable, and of course, a lot of that inflation was globally inherited or globally imported back in the 1990s. And then in the 1990s, inflation targeting around the world became important. The Reserve Bank Act has made that happen, and look how it's managed to constrain inflation within a pretty tight band there. So I guess, Andrew, you may have a few words to say on this, but my sort of view on this one is do not underestimate the Reserve Bank when they say they want to keep interest rates low, right? They have blunt but powerful weapons, yeah?
Absolutely. And I mean, if they believe that orange line is going to go outside the top of that band significantly over the long term, they will put interest rates up, but they won't put them up unless they think it's unsustainable.
Yeah. So ignore or think they're wrong at your peril, or focus on the short-term noise at your peril. The long-term trend is for interest rates they've gone down and is to stay down. In that context, of course, things like how much fees you pay for your funds, what you pay for your mortgage, and all that sort of thing becomes really important, because if you're making, when interest rates are down, your funds will overall make less money in the long term. If you've got a low interest rate environment, you only have to make a little bit above that to justify it. But then if your fee is still, 1% of something, it really eats into the returns. Here's the other big trend that we need to focus on. This Kiwisaver is changing New Zealand. And we see this at the coalface as investing money, but I just wanted to remind members of this. 14 years ago, we had nothing saved in Kiwisaver. It hadn't even started. Now we have $82 billion. It keeps on going. Since I've done this slide, it's gone up. Treasury tells us it could be 200 billion by 2030, 500 billion by 2050. Let me give you some numbers there. 500 billion is 2.5 times our current GDP. That compound interest rate growth is something around 2.2, 2.3% of GDP of net savings every year. That is a rising tide of capital. You don't notice it. We notice tidal waves. They make the news. Rising tides are a bit boring. In fact, if you look at it, you don't even see it rising, and then you turn back and say, oh, the tide's gone up. That's what's happening in New Zealand. And in fact, you can see that Simplicity has been net buyers of securities every single day, all through COVID and afterwards, because you're saving a little bit of money. So we keep on investing it. And when you get that rising tide of capital and the certainty of that happening, and it's becoming a certainty now, that means investment managers like ourselves start making some very long-term decisions about how we invest that capital. And it means also that it's almost like there's blood flowing through the body of the national economy, even when people are concerned in times like COVID and so on. Businesses carry on operating. Capital keeps on flowing. You can see a really powerful example of this, I should say, in Australia. If you look at Australia back in 1980 when they started saving, they've now accumulated $3 trillion, $3,000 billion. And for 26 years until COVID, Australia did not have a recession. 26 years. Now, why was that? People say, oh, it's because the price of iron ore and they were exporting to China and there was always money coming in. That's not the case at all. In fact, if you look at the mineral profile of Australia, it's quite similar to the Republic of Congo. So why are they two different? Well, obviously one of them is a democracy and the other isn't. But the other key factor was the Australians saved their money when they came in. And that means that when they threatened to go into a recession, the superannuation funds were still building the buildings, still funding the infrastructure, still funding the businesses, and it created a much smoother economy. So you're much more likely to see now. In fact, I'm pretty, I don't like making predictions, but I will make this one. New Zealand is about to enter a period of prosperity that it perhaps has never seen, and certainly the strongest period of prosperity since the end of World War II, because we're saving money and investing money in our economy. The other figure I'll give you, which economists would use, is called a GDP multiplier. What that means is, what does the impact of a dollar invested have on the economy? Well, what we know over time is that a dollar invested from a domestic source, like us, Kiwisavers, has 2 times the effect of a dollar invested from overseas. So you're going to see this rising tide of capital, and also it has a multiplying effect on the economy. So if you have kids or grandkids or a young person entering the workforce now, boy, you've timed it really well. I mean, in spite of all the noise about COVID right now, we are entering a period of prosperity like I don't think we've seen for a very long time. So, but however, what can I do? You talk about these macroeconomic things. Yes, interest rates may stay low. Kiwisaver is starting to transform the economy. The fundamental long-term picture is a very positive one, but what can I do right now? Well, here's the first thing, and I know you hear us say this, but with lower interest rates, this matters so much. The reality is the average New Zealander will pay about $47,000 in Kiwisaver fees over their lifetimes, more than they will pay for their mobile phone, more than they will pay for their power bill. So doesn't matter if with markets going up and down, COVID or not, the story remains the same. Be paranoid about the fees you pay. And by the way, it relates to any money you borrow as well. The interest rate charged is massive. You either get compounding interest. If you understand compounding interest, you'll get it working for you. If you don't, it will work against you. And as you know, the average Kiwisaver fund will return about 5% over its lifetime. That's the average balanced managed fund of Kiwisaver or non-Kiwisaver. If you are paying 1% of that 5% in fees, that means 20% of everything you make is gone every year, right? So the fee is not 1%, it's 20% of everything that you make over time. And as you know, well, you may have seen this chart beforehand. These are all numbers from the Sorted website. The average person will pay $47,000. We charge about $14,200. So you save $32,000 in hard fees, and the compounding effect of that staying in the account means that the average person, based on current fee levels, will be about $60,000 better off. And that's just same investments, right? There's nothing about the investment returns there, just about the fees charged. It's a massive, powerful factor. And I don't know if you know this, but that's what $60,000 buys you, right? And where I come from, Sunnyvale in West Auckland, pretty poor part of town, or it certainly was when I was there, $60,000 is a fortune. And it would mean that you can have a warm house and the food you want to eat. It just gives you a lot of choices and dignity in life. The other message here, I think, is people are talking about the share market. Is it too toppy? Is it too high? Once again, short-term thinking. Don't be afraid of investing in shares long-term. Here's a chart from Australia. It's got 120 years of returns. We chose Australia because New Zealand doesn't have a long enough data set. And as you'll see there, if you put $1 into Australian shares, and this is not adjusted for inflation, and this just assumes all the dividends are reinvested, right? So this is really, that would not be the practical, and it's before tax. So this is not the practical what you would get, but I just want to show you the impact of asset classes. $1 in the Australian share market would now be worth $280,000, assuming you weren't taxed. Average return of about 12%. That's pretty much what people would expect over the long time. If you stuck it into the Australian bond market, government bonds, you'd get about 6% over that time. That would only be $688. It's amazing what that 5% difference between 6% and 6% difference between 6 and 12%. And if you stuck it in the Aussie bank, you get $204 because you only get 4.8%. Now, so I think most people on this call would know you get rewarded for the risk you take by investing in shares. But I think what's interesting is just look at that red line. That red line, when you see it in the context of history, looks pretty smooth. Doesn't look that bad, right? You think, oh yeah, it goes up and down. But of course, in those times, and look at where those arrows are, there are some tremendous changes that can really spook you. Look at the depression back in 1928, 1930. Looks like a significant blip, but it doesn't look as bad as it must have felt when you were there, right? And go right up to, say, 2008 global financial crisis, just before that right-hand black arrow there, right at the base of that arrow. Global financial crisis. If you were living in that, you would have been it was very scary, right? We thought the whole banking system was going to fall over. So in the context of history, none of these things are that dramatic and you get rewarded over time. But at the time, it feels really scary. And we have this amazing psychological phenomenon called loss aversion. What that means is we hate losing a dollar more than we love making a dollar, right? So when we react much more powerfully to bad news, right? When you've made money in your portfolio, you can say, yes, of course, and sometimes you pat yourself on the back, didn't I make a smart decision? And then the market goes down and you start losing money and you get a fear, a panic. This is a very natural biological reaction. It is not unusual in those circumstances that to fear that way. The issue is, as an investor, you cannot allow yourself to get captured by fear and emotion. Because look what happened in COVID. If you sold out at the bottom, you have given away a fortune in subsequent returns. So how do you deal with loss aversion? How do you benefit from that red line and with all the bumps and so on and so forth, and actually get rewarded for the risk you take over time? Well, it's really simple, folks. It's diversification. It's a really simple thing. So this is a chart produced by Mercer. It shows every single year from 2011 to 2020. And at the top is the best performing asset class, and at the bottom is the worst performing asset class. Now, you don't have to read all the writing in there. Just look at the colors. Just choose a color. Choose, say, that pink one, because it's pretty obvious. Emerging market debt in the middle there in 2011. It was in the middle. It goes down, 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 down. Then it goes up, up, down, down. So it's a random pattern. I'll just give you 15 seconds to look at that chart. See if you can pick a pattern. Hopefully, you've seen now that there is no pattern. It's totally random. In fact, let me ask you another question. In 2021, can you tell me what it's going to look like? And if you go to all of these active managers and say, so tell us what it's going to look like in 2021, nobody knows. It's completely random. However, there's a really important lesson in this chart, is that in every year, some things will win and some things will lose. Look at the top line. Every single year, some asset classes have done more than 10%, regardless of what the overall market has done. And down the bottom, some of them have either almost made nothing, or have lost money. So the way to get rid of loss aversion and the way to get rid of fear is knowing that you've got so many investments in so many places that you will always have some winners and losers. Classic case would be COVID. You may have panicked because you had Air New Zealand in your portfolio. You would have felt really, really cool if you had Fisher & Paykel Healthcare. And if you had both, one offsets the other. And it means that you're less inclined to make panicky decisions about investments. So diversify, diversify, diversify. That is why we have 3,000 in every one of our conservative balance and growth funds, whether it's Kiwisaver or non-Kiwisaver. You have 3,000 investments in 23 different countries. And in fact, you'll see us starting to change a little bit the way that we'll be investing in the future. We've done it with doing mortgage investments. Now we're doing first home loan mortgages. We've started to make some investments in private equity and venture capital. A huge driver of that is to get more diversification into the portfolio. And here's the other thing is don't trade markets. Here's a really interesting chart produced by JP Morgan. I'm not the biggest fan of banks, but I do like some of the data that they produce. And here's a really interesting one. So if you put $10,000 in the US share market in 1999, and let's just say you stuck it in the bottom drawer and you never looked at it again, and you pulled it out today, it would now be worth almost $30,000. You would have made about 5.6% average return in the last, what's that, Andrew, 22 years. So, but if you'd missed the 10 best days, let's just say you said, the market's too toppy, I'm getting out, it's crazy, I'm just going to be out for 10 days. If you missed the 10 best days, that portfolio return will be halved. That means half of the returns in the last 22 years were made in 10 days. So let me ask you a question. Do you know what 10 days those were? It's only in hindsight that you ever get wise on this, right? It's impossible to predict when the next 10 days will be. And in fact, it gets even worse. If you just missed 20 days, you would have lost money. Your $10,000 would be worth $9,359, right down to a significant loss if you'd missed the 60 best days. it'd only be worth $2,000. So there's a really powerful lesson in there. Don't trade markets. You can't get it right. And the other one is just the compounding effect of saving. Just the little chart I share, which I think surprises a few people, because Einstein called compounding interest the eighth wonder of the world for a very good reason. So let's say you were born, when you were born, your mum and dad stuck $1 a day into your Kiwisaver account until you were 65. You'd have $23,660. Every single one of us lives exactly 23,660 days from the day we were born to the day we retire. By the way, folks, no one gets a day extra and no one has a day less if they get to retirement. So you would have put in 23,660, or your parents would have. With a 5% return, that would be worth $170,000. Now, this is using a 5% after-tax return. That means that you've put in 23,000, compounding interest has given you another $147,000. Amazing. But look at the effect of compounding interest as you go up, because the money that you've made makes money every single year. It just carries on compounding up. That means that if you get up to an 8% return, your $23,000 is actually $674,000. Now, this is after tax. You should not take that as an expectation of what you will earn, because you have to pay tax on it and so on. But it's just showing the tremendous impact of compounding interest. And obviously, and just the thing, and folks, I know we keep on talking about this, but if we're in a low interest rate environment, do not expect to have 11, 12, 13, 14% returns on your portfolio. The interest rate fundamentally sets the return profile for all other asset classes over time. You do get an increase, a big increase, as people get used to the idea of low interest rates. And then the reality of low interest rates kicks in, which means lower returns for everybody. In that case, fees matters even more. Because if we had a year with a 2% return, I have no idea whether we will, but if we do, and your fund you're being charged 1% asset management fee, your what I call your tax rate for investing has just gone up from 20%, which is one out of 1% on 5%, has now gone up to 50%. Every $2 you make, $1 gets paid in fees. That really hurts returns long term. So I'll just click out of that right now, and we will go, let me stop screen sharing here, and then we will go to our questions. I'm sure there are heaps and heaps of questions. So Andrew, let's you and I share them out here. Do you want to be question master?
I'm happy to do that. And so starting with, and there's so many, I'll start from the beginning and work my way through them. So Spencer asked, does ethical investing mean that companies that are involved in discriminatory or sexist employment practices won't be invested in? I'll answer the first part of that, Sam, because I can do the technical stuff. You can answer it more philosophically. We would like to, excuse me, we would like to screen out more than we currently do in that sphere, sexist employment practices. The entity that we use, Vanguard, the index that they manage for our international shares, has a screen for labour rights. They do want to put in their diversification, but it's difficult to measure. And this, I suppose, is the problem we have, if you like, in that we invest in just about everything, and we try not to invest in things which are in practices that we're not comfortable with. But that has to be measured somehow in a way that you can do very simply in order for it to be practical. And so, as I say, where possible, we absolutely do, but we can't screen everything out because we don't do individual stock selection. That's why we've got 3,000 odd companies in our portfolios, small investments in many rather than larger investments in a select few. And so that is a problem for us, but it's as far as we possibly can, we screen out anybody who is involved in any sort of practices that we're not comfortable with. Sam, do you want to expand on that?
Yeah, so I'd say this. So there's no screen for sexism in companies. There's no international benchmark that where someone else does the work and that allows us to say yes or no. But I'll tell you what we do. For 2 years now, we've funded a survey by AUT about corporate governance diversity. So our view is this: we're going to be invested in a lot of companies for a very long time. We think great companies are a combination of a good idea, money, and people. The good ideas are everywhere on your smartphone. There's not many new ideas out there anymore. There's a lot of money around, obviously, to invest. We've been talking about that with the rising tide of Kiwisaver, but it's always the quality of the people in the business that determines a company's success. If you are not drawing from the deepest and widest well of talent, you're going to have a competitive disadvantage. So we've been wanting to put a lot of sunlight on that with surveys with AUT, and I think we're going to do that with another university now. I spent a lot of time with boards of directors of the biggest companies in New Zealand saying this matters to us as a shareholder. There are really, it's really the most important thing is diversity, because if you think about long-term sustainable returns, you just have to have the best quality talent in there. So that's what we do. It's a bit more of a proactive thing, and there is no benchmark for that otherwise in terms of screening out companies.
Yeah, we're going to have to screen through some of these because we do have a lot coming through from Facebook as well. I will pass it on only because it's specifically for you, Sam. From AD, I've enjoyed your articles and stuff with a balanced and non-alarmist view of the economy. How frustrating can it be reading some other economic commentary where it appears they're all trying to shout the loudest with crazy comments or just to get attention?
Yeah, look, you just have to be careful about what you read. And listen, if you're going to read and pay attention to economists and let them influence how you think, make it a broad spectrum. Do a lot of reading so you can so it sort of moderates the views of any one particular person. And right now, of course, you get some crazy alarmist. I mean, I just laugh at what the economists were doing this time last year, thinking the world was going to end, when in fact COVID, it hasn't destroyed a single ship. It hasn't destroyed a single factory. Yes, it is a problem. Of course, it's a big problem. But in the long-term context of investing, this is a blip. This is a short-term phenomenon. So, but thank you very much for your comments. There's a comment here from anonymous one. If I have $1,000 to invest in, I'm better off buying $1,000 of investments right now or drip feeding it at $100 a week. Well, we can't give personal advice, but I think a sensible thing to do generally, what I would do in that circumstance is I would put in $100 a week. I might even put in $100 a month. That's called dollar cost averaging. One of the awesome things about markets going down, remember that markets going down is also good for investors, not bad. If you are investing, that means you get to buy everything you bought last week at a lower price. Investments go on sale when markets go down. So if you are investing, a long-term saver like a Kiwisaver, you benefit from buying more for the same amount of money. That actually ultimately works for you. You just don't want markets to go up all the time. Well, they don't go up all the time, but even then, if you're in a long-term investor, you want them to go down. So
okay, we'll go to one from Facebook, from John. At age 65, I'm thinking about withdrawing my Kiwisaver and moving to investment funds to allow a 3-pot strategy. This will allow my money to be split between short, medium, and long term, so growth, balanced, and conservative. Can you see any cost or tax disadvantages for this, or is a better approach to reduce, or a better approach to reduce costs? I can start with that one, Sam, if you want to follow on. But it sounds, John, as though you've certainly got your ideas in sync, and as within our investment funds, you pay exactly the same fee. The tax is exactly the same across the three. So if that's how you want to allocate your funds, that makes perfect sense. And for us, anyway, there's no better way to reduce costs. Is there anything you want to add, Sam?
No, I think that's fine. And I think there's another one there, Andrew will pass on. Can we talk about investing spare cash versus using it to pay down extra on the mortgage? Oh, look, I have a really, really simple piece of advice here. Every single adult over 18 must have a Kiwisaver account. They must invest $1,042 a year, regardless, into it, because then the government will give you $521 of a government contribution. They'll match you dollar for dollar. So if you put in $20 a week, the government will give you $10 a week. That's free money. It's a 50% return on your at $20. It's a total no-brainer. So every single adult must have that. Now, after that, you will obviously get your employer contributions and your contributions, so you should match your employer contributions. But after that, if you have discretionary cash and you have a mortgage, pay down the mortgage, because you're paying interest on the mortgage. And the interest you have to pay comes out of your after-tax earnings. So I don't know if many Kiwisaver managers would say this, but don't invest into Kiwisaver if you have a mortgage to pay down after you've got the government contribution, after you've matched your member employer contributions. You should be wealthier in theory by paying down your mortgage. Yeah, so.
Okay, there's a few here we can nip through fairly quickly. Any plans to offer a Kiwisaver fund with more growth assets than the current growth fund with the investments locked in until retirement? I would go for one that we keen for 100% stocks. Sam, you?
Well, yeah, we get asked this every now and again. People want us to have 100% share funds. We have very simple growth, balanced and conservative funds. Look, we're thinking about it. I think the most important thing for us next is to get a regular income option for investors, particularly retirees. But I think that is going to happen. I just can't promise you when, but I totally hear you.
Going back to the chat, does Simplicity offer refinancing options for existing home loans? At the moment, no, we don't. We only do first home mortgages. We're keeping it very restricted as we ease our way into this sector, but who knows in time. Fair?
Yeah, I mean, we're restricted in terms of refinancing. Of course, any member who wants to buy a first home can apply for a first home with us. Now we've opened that up, so it's available to all members, but it does need to be your first home. We only have so much money to lend, so we think it does the most good in the first home market. Then also, of course, there's the least default in the first home market as well. The last bill people won't pay is their mortgage or their rent. In fact, one of the reasons why our conservative fund is the number one performer is because, instead of giving money to the bank and getting much less than 1% return, we lend it out of mortgages at 1.9%, which is still the cheapest floating rate mortgage in the country, but it actually more than doubles the return for the Kiwisaver members and the investment fund members who are providing that money to lend. It's just like an old building society or thrift society back in the old days. We've just bought it online. That's not a new idea at all, the fact that members should lend to members. But unfortunately, if we open it up to the refinancing market, we would have billions of dollars worth of demand overnight. Because if we said you can refinance your home loan at 1.9% floating, the whole world would want to do business with us. We just don't have that much money to lend. Can I just address one, Andrew's common theme about the older population, the over 60s, because they're getting really squeezed with these interest rates right now, yeah? So once again, folks, we can't give you individual, personal financial advice, but I would say this. If you think about this in the long term, people generally live longer than they think they will. I think statistically, if you live to 60, the chances are that you will live to your late 80s. So you need to make your money last longer. That also means that you have a longer window to invest, and it means that you can take the ups and downs of financial markets more. So as a general rule, I think that while psychologically you feel, look, this is all the money I've got, I need it to be a safe nest egg, I'll stick it in the bank. The reality of it is that you will need to get higher returns, many people, therefore they will need to take on more risk in doing that. But how you mitigate that is that diversification again. So as long as you don't need all your money at once, the idea of having your retirement savings in a balanced fund or a growth fund and just taking a regular deduction. We have lots of members who just, even on the National Super Day, they just take a regular, $100 a week, $200 a week, or whatever they want. So that creates the feeling of income for them, but they've still got the assets working for them over the long term. But of course, the value of those assets can go down at any one time. So I think the way to manage this when you're over 60 is actually to get into a diversified low fee fund and to take a regular withdrawal, but accept that financial markets can go down and up. And if you absolutely do not want to lose $1 of capital under any circumstances, well, then I guess you'll need to have your money in the bank and bank deposits and earn less money. But the big lesson for over 60s, I think, is you're going to live longer. That also gives you a longer investment environment. As long as you're careful about having a very diversified fund and paying low fees, you can actually make that money last longer by doing
that. Great. Couple of questions on your slides, Sam. I'll have a look at the why no access headings one. On slide 13, the yellow, which is the debt, the global debt chart, the yellow was actually countries with debt close to zero, because I could see Norway was in yellow. I noticed that too. So we'll work on those slides.
And there was one, I think Russia was in green, which had zero as well. And trust me, folks, they're just lying. It's not true.
Yeah. Okay. Question from Facebook. Thanks, Sam and Andrew. Can you tell me if it's better to move to growth versus the current balance fund for someone retiring in a year's time? I'll leave that with you, Sam, while I quickly get to some of the others.
Yeah, look, I don't know. It depends very much on your personal circumstances. I'll tell you what I'm going to do. I'll just give you my example. And I eat our cooking at Simplicity. So I just own, myself and my partner own our house. Then I have a Kiwisaver fund, and I have a small rainy day fund as well for emergencies. But my Kiwisaver fund is in the growth fund. It will be until I'm about 70 to 80. And the reason being that I'm prepared to accept those ups and downs and just take a regular amount out when I retire, because I know that, history is firmly on the side of growth funds outperforming. You saw that with the share market chart. You see that with growth funds generally, and I don't need all of the money at once. So I think the question is not so much about balanced or growth. It is, how long do you want your money to last, and how much would you need at any one particular time? And if you don't need a lot at any one particular time, if you just want a regular income from it, then you can afford to take more risk, but keep it diversified and make sure it's in a low fee fund. As a general rule, and this is my personal opinion, too many people have too much of their money in low risk assets for too long, and they just give up on returns in order for this perception of safety. Remember that thing I talked about, loss aversion. You hate the idea of losing a dollar. You hate the idea of markets going down, and it's okay if they go up. Well, if you're going to invest out of fear, that's perfectly fine. It's perfectly, and it may well be very suitable for some people. But if fear is the motivator, you will assuage that fear. You'll get rid of that fear, but it will cost you a lot in returns over the long term.
Excellent. And there are some really good questions here. So let's try and get through as many as we can, as quickly as we can. There's one that's a reasonably straightforward one for us to answer, only because of our philosophy. With the cost of assets record high in regards to PE ratios and Warren Buffett indicators, should we keep investing or slow down and cash up for a drop in market prices? I think we sort of covered that.
Yeah, I think we sort of have. Yep.
I think, in our view, just continually stay invested, go for the long term.
Can I grab one here from Ben? What effect will becoming a default provider have on Simplicity? Will the critical mass mean lower fees will be able to be charged? The answer is it'll have a really positive effect on us in terms of scale. So that's great, and we're all ready for it. We wouldn't have applied for it if we didn't think we could handle it. And yes, scale always benefits members. We have lowered our fees 4 times in 5 years in terms of making things like kids free, lowering our annual fee and so on. We will carry on doing that as we get scale. We want to be the most hated fund manager in New Zealand by our competitors, because we just keep on lowering fees and we keep on showing you what it really costs to run an asset management business. So we hope that by Christmas we'll have some good news in that area.
Cover off one from Wayne. It's great you're a charity, but what do you do yourself and the directors earn from as salary or wages and bonuses, etc.?
Sure. So as a charity, the charity is actually funded almost entirely by volunteers. All of the trustees are volunteers. We have 1 and a bit people working on the grant distributions. Of that, the one person who's running it is also a volunteer. We have a salaried, on a very modest salary there, who's helping out with the donations. Hopefully that answers your question. The other one is about Simplicity New Zealand. Look, it would be, well, I think I'd be breaching privacy to tell you what everyone else was getting paid there, but I can assure you that it is, well, Andrew, you and I both know that we're getting paid well below what we would otherwise be getting in the market, but because we're primarily working for love here. But look, I think people generally in Simplicity, we have 21 staff. I think they would unanimously pretty much say they're paid fairly for what they do. They're paid below finance industry market rates. But it's fair. But fundamentally, we're working here because we have a purpose in life. Now, if you'd like to, just send me an email. I'll tell you what I get paid. Yeah, it's fine.
And the Simplicity NZ directors do get a fee, but it's
they do
very much.
Yeah, the Simplicity New Zealand fee, they get a fee. It is way below market. Yeah. They are also doing it primarily for love and for a sense of purpose.
Thanks. So replying to a question from Dawn, which is interested in your potential plans to invest and support additional social housing. Is this progressing any further at this stage? I can cover the general thing there, Sam. Yeah. There is a very important point to make though, and that is that under the regulations, and I think we are trying to work in the best interest of all of our investors. We have to make sure that any investment we make is in the best interest of our investors. And what that means is that, unfortunately, there are at times where there are deals that are, because they're for social reasons or whatever, the return you're likely to get from that investment is not as high as it would be from something out in the market. And so we're not permitted to do that. We have to assess every deal that we look at to make sure that it is in the best interest of our investors. In other words, that we are getting adequately compensated for whatever risk we're taking. That said, there are entities out there who are producing good products that are actually paying genuinely market rate, but funding particularly community housing. And so we're very engaged in conversation with those entities, and I hope we'll be continuing to invest in them. We've only managed to make one investment so far because that's the only one that's come up, but there are 2 or 3 quite good ones on the horizon.
Could you describe what that was, Andrew, the size of it?
The total deal, I think, was 20 million, and we were an investor, co-investor in there. We actually signed up to something called the AOTIA Pledge, which is a commitment to finance community housing projects, provided they reach a certain threshold. The total pledge was 100 million, and we were 20 million of that, so we were the largest single investor in that arrangement.
And then we're also having a very serious look at and maybe announcing something relatively shortly in build-to-rent housing too, where we think that's you can build, own and operate affordable housing. You can provide very long-term rental agreements. In fact, maybe lifetime rental agreements, so that people have, a warm, dry, safe home. And that also ends up being a fantastic investment as well. Folks, the finance industry is so focused on making money. What they've also forgotten is that you can do good. You can make money and do good, which is exactly what we're doing now. As Andrew said, we do not make you less money because we do good. Actually, we make you more money because we do good. The ethical investing screens means our portfolios have outperformed by 0.5 to 1.5% over the years, just by screening out the bad stuff. Doing things like mortgages, where we can do low-cost mortgages, still make members more money. Investing in high-growth New Zealand companies like we do via Icehouse makes people more money and still does good. So it's possible to do both. Can I just jump onto one about crypto here, Andrew? We've got sure. A couple of questions about crypto. Look, it's very simple. We don't invest in it, and the reason is that crypto right now is a little bit more like gambling than it is investing. It will settle down. The industry will settle down, but and with that will come regulation and taxation. So when this is an industry that's regulated properly and taxed properly, then we will start thinking about investing in it. But right now it is the Wild West. And look, some people did incredibly well in the Wild West, and some people make a lot of money. But we are not putting your money, which are long-term investments, into, well, right now, what is a short-term, highly volatile, untaxed, unregulated world of crypto. So it may be the best thing since sliced bread for people who are gambling with it right now, and good on you if you are. It's your money, but if you give us money, we will be investing in things that are way more it's sensibly regulated, taxed, and operate in a much more mature fashion. So, there'll be nothing from us on crypto. You see, I publicly state that it's gambling, not investing. As long as you treat it that way, as long as it's like going and having a flutter on the horses or going to the casino, fantastic. It's your choice, your money. You should do that. I want to actually address one here about active versus passive, Andrew. And there's a really interesting one. I understand the appeal of a passive fund with low fees, but it's hard to ignore managed funds like Milford that consistently have higher performance net of fees compared to passive funds. What are your thoughts on passive versus managed funds when considering funds like Milford that have consistently outperformed massive funds? Yeah, absolutely. Well, if you have a look at our long-term returns, there are not many funds that have beaten us. In fact, in the conservative funds, no one has. But there are funds like Milford, and I very publicly have said Brian Gaynor, who used to own and run Milford, he's one of my investment heroes. And there are periods of time where active managers do win, and Milford is a very well-resourced, very capable, it's a firm I have a lot of respect for. But when we set up Simplicity, we set it up to make you the best long-term returns. And we know from history that the way to do that is to minimize fees and invest in the market. And you will see that in the 3-year returns now. Charging the lowest fee has already taken us to number 1 in conservative funds. We're in the top quintile, top 15% for balanced and growth, and sometimes we've been even higher. The compounding effect of those low fees slowly wins. So I have a lot of admiration for the people who run Milford. The problem I have with that is nothing to do with them. It's that they retire. These great stock pickers will retire. You will typically be invested for much longer period of time than they will be working, investing your money. Statistically, Standard & Poor's have done a survey on this. It's called the SPIVA studies. You can see them online, SPIVA. They're the studies that no other fund manager wants you to see, no active manager wants you to see. What the SPIVA studies show is that around the world, over a 30-year period, and remember, most people are investing for that long, there is a less than 1% chance of picking an active manager who will beat the market. So if you can find that 1 in 100 manager and stick with them, good on you, go for it. But we could not possibly be that, and we could not possibly pick those fund managers around the world. And the simple reality is this: the fund managers will beat the market from time to time, and you'll always hear about when they've beaten the market. They always shout from the rooftops. They go suspiciously quiet when they underperform the markets, but you can't beat the compounding effect of those fees. You just cannot beat the market consistently enough to make up for the fact that you charge higher fees. So that's what the SPIVA studies show. That's actually the that's the studies upon which we base the decision to do what we did in Simplicity. There's an awful lot of history showing it, and it's all around the world. They're very embarrassing. So Milford are wonderful. Will they be wonderful in 5, 10, 15 years' time? I don't know. What I do know is that Simplicity will carry on giving you market returns less the lowest fee and continually pass on the benefits of scale to you in the form of lower fees. That is the winning strategy. By the way, it's boring. We like to call ourselves the most boring fund manager in town. It's the tortoise strategy. Active managers are the hares, but we know that the tortoise beats the hare. And there's one other one about how much does Simplicity have to grow before it runs its own Australian share fund for much better tax efficiency? Well, Andrew, do you want to do that, or I'm happy to do that?
Just in terms of investing in the Australian share market, I don't think running our own fund would be any more efficient. The tax on the Australian share fund is as if we were investing them directly ourselves. And it's a question from an earlier person as well, in regards to our global share fund. We don't invest in ETFs, which was the question previously, but we invest directly in a wholesale managed fund that is based in Australia, which is where all of our global equity share investments are. And yes, there is a slight tax inefficiency because we're invested in an Australian vehicle. It costs us approximately 0.3% per year in returns. However, in order for us to move that to New Zealand and operate it from New Zealand, right here, right now, I don't know what level of scale we need to get to run it ourselves, but any option that we look at, the overall fee might be okay, but the underlying costs of running that would more than offset the 30 basis points, the 0.3% that we lose at the moment in tax. So it's not practical for us to consider managing a global equity portfolio from New Zealand as it stands. If we maybe double, I don't know, I would be guessing to say that if we had about twice as much as we currently have in global shares, we could start looking at options for managing from New Zealand. But right here, right now, it's not practical. Anything you want to expand on that, Sam?
Yeah, no, absolutely fine. Look, we want to make you wealthier. So if we set up funds domestically to pay less tax, if that actually makes you wealthier at the end, rather than just being a marketing spin, which in many cases it is, with some of our competitors, they say, yes, we've got tax efficiency, but then add up all the fees and to actually get that, it's not worth it. So as soon as it is practical and useful and makes you wealthier, we'll do it for sure. Just one here, with Simplicity growing in fund value, will the fees be reduced to the level of Vanguard and BlackRock? Well, actually, in many cases, they already are at that level, but I think you're talking about if you can buy these big US, S&P type fees at about 5 basis points. We will continue. Obviously, we do more than just manage the fund. We keep member registries, we have customer services, we have a business to run, compliance, regulatory, all that sort of stuff. But suffice it to say, we're just going to keep on lowering fees as we get scale. So absolutely, will it get close to those fees? If you look at the retail cost of investing in those, absolutely it will. But except that with us, it won't just be one fund, it'll be diversified, regulated in New Zealand, the Kiwisaver scheme, all that sort of stuff.
So there's quite a technical one here, Sam, but it is a sort of broad question on a more general sense. It's from Catherine. Are you measuring the carbon footprint of your funds, and do you have plans to commit to net zero by 2050? If so, will you join a leading net zero climate investor initiative such as the Net Zero Investor Framework or the Net Zero Asset Owner Alliance?
It's a good question. So the answer is yes and no. So I think you think about this in two things. Will we as a business seek to be carbon neutral? Yes, we will, and we do everything we can right now. You know, our office is basically repurposed goods. We hardly ever buy anything new. We always carbon offset the travel, the flights that we do and so on. So we're just moving down that path as a business. Of the companies we invest in, that's a much bigger issue, right? Because then it's the how will they commit to carbon neutral, carbon zero? Then, of course, we're investing internationally. So there's a question about the domestic and then the international. Look, so rather than get into a lot of detail, let me say this. As a business, we are an infinite company, right? We want to invest forever. We want this planet to last forever. We want businesses to be going on forever. So we are, of course, massively interested in this issue long term because it is the great issue of our generation now. So we will do whatever we need to do in order to encourage us along in a way that does not cost our members a fortune, or in a way that does not create the illusion of activity without the substance of it. Our industry is famous for virtue signaling and for greenwashing and all that sort of stuff. We will do what actually matters, what makes a difference. And it's in many different areas. I'll give you an example. We're planting a native tree for every member that joins us now. I think we're the 6th biggest corporate sponsor of native trees in New Zealand now. We're going to carry on doing that. Now that's something sensible to do. We do that with the Simplicity Charitable Trust. It's one of many things that we will do to do this. So totally get your messaging, totally get what you would like us to do, and without specifically committing to any one thing in the short term and the long term, that's where we're totally focused. Can I just ask
what these default members, Sam? I don't know where we're going to go with these.
Yeah, exactly. Can I just do one from Stuart, which is a really interesting one? Why can we say inflation is within the target band when asset prices have clearly inflated at a more significant rate, i.e. house prices have gone up 25%, share markets up 20%? Is the CPI a fair indicator? Is the CPI a fair indicator of the cost of living in New Zealand? No, it's not, Stuart. If you want to buy a house, for sure. I mean, there is stuff which is house price inflation is not part of the CPI, so that's an issue there. And of course, that limits then the ability of the Reserve Bank to do things to bring house prices down, although you have to question whether or not it's in the ability of any Reserve Bank to control the price of houses, particularly when the government has just helicoptered billions of dollars into the economy, right, because of the COVID response. So I think it would be unrealistic to expect the Reserve Bank to put a lid on that. And I think Adrian Orr pretty much said that last night, didn't he, Andrew? He says, look, I can't control house prices, I'm sorry. But the important thing is that they are nevertheless targeted on a whole lot of the expenses we have in our lives, food, transport, energy, all that sort of thing, keeping inflation within a band there. So it's not perfect, I agree with you. It is an awful lot better than it was. I guess our point was, don't bet against the Reserve Bank keeping the stuff it can control under control.
One there, I'll just see if you want to cover this, Sam, from, I can't see the name, but how can Simplicity offering help to set up kids for success?
Yeah, how do you set up kids for success? Well, really simple. Get a Kiwisaver account and start saving into it regularly, and get aunties and uncles and grandparents and whatever. I'll tell you why I'm so passionate about this for kids, because with Kiwisaver, it means the kids can't touch it. You can't pull the money out to buy a Nintendo if you want to. It stays in there. Kiwisaver fees generally have lower fees. It's the best regulated financial scheme in New Zealand. It has a lot of political support. So it's going to be a great long-term savings vehicle. You can pull out the money to buy your first house. It's available for you in hardship. It's not perfect, nothing is. But as a savings vehicle for kids, it is by far the best thing I've seen in a long term. The best thing since the savings account, right? All those little ASB, well, those are elephants or cash-ins we used to put stuff in when I was a kid. So that's how I think how you best set up your kids. But that's money. I tell you that the way you really set up your kids is teach them about money. Talk about money. Money's really simple. Get them familiar with the idea. Our finance industry are parasites and trade on fear and ignorance. So we are taught, these bank billboards with these pretty messages about happy families jumping off into swimming pools. It's not telling you anything about money. The subliminal message there is money is scary and horrible. Just give it to us and you can get on with it in your life. A lot of our competitors say, give it to us, we'll sort it out, then you can get on with your life. What they're really saying is, give us your money, we'll charge you a high fee, we'll do we'll do whatever we can. Thank you very much. So the more you learn about money, the more you understand, the more it's part of your daily conversation, the more you'll feel comfortable about it, and therefore the less intimidated you'll be and the more sensible decisions you'll make. So best way to get your kids ready financially is to just talk about money. And as an average person, you're paying bills, you're borrowing money, you're getting salaries and wages. You're actually a money expert without knowing it. The real truths of money are very simple in life. Pretty much everyone has them. So let's just chat about it with your kids. Yeah.
I'm looking at this and we're well over an hour now. And there's a lot of questions here that I'd really like to answer.
Okay, well, we can carry on. Folks, if you just want to stay on, we'll carry on answering questions because we've got time, haven't we, Andrew?
Oh,
yeah. Let's just carry on going. Let's charge on through.
Okay, well, let's put one comment that's come through, and I'd noticed actually on a headline that come over here that unfortunately Sir Michael Cullen has died, which is very sad. And as somebody here said, he was the father of Kiwisaver, and
he really was. Oh, that's very sad indeed. Wow.
Had a bit to do with it.
Had a personal relationship with Michael. Actually, I've just got to pause here for a second. He was one of my mentors. That's incredibly sad.
So, well, I'll comment on a comment from Bruce here. To what extent does increase in share market investor numbers and dollars drive overall share market performance? Is the move of money from term deposits to investment funds the reason for share market performance? And is this a real misleading driver? Well, interesting, Bruce. I mean, firstly, we've witnessed exactly that, very much so. Significant amounts of money coming out of term deposits coming into our funds. And obviously the returns, particularly from the balance and the growth fund, have been pretty good for a while now. Whether it's driving share prices, it may be to an extent, but actually New Zealand as a market hasn't performed particularly well at times in the recent past. So I don't think it's a domestic thing, but it is a slight concern because I doubt very much personally that everybody that has moved money out of a bank term deposit into, for example, a conservative fund or a balanced fund, because they've looked at the returns, understands how much more risk they're taking in terms of the capital value of their money. But on the other hand, it's exactly as Sam's saying. In this environment, with interest rates as low as they are, you have to try and find something which is going to return you something better, and provided they're going into genuinely diversified funds, their actual risk of losing their capital is negligible from our point of view. However, it will just fluctuate more. So, but as to whether it's driving share prices, I personally doubt it. Anything additional, Sam?
That's absolutely fine, Andrew. So, question here: you advise to diversify and highlight the broad diversification of your funds. But if I have a big chunk of cash to invest, should I diversify across more than just Simplicity to other investment companies? Well, and that's from Gary. Hi, Gary. Well, in the first instance, Gary, I would say you should get some financial advice from a fee-based advisor. So go to an advisor who does not charge you a commission and just charges you a fee, and ask them for advice. But as a general rule, I would say this: look, by all means, you can choose other managers, and many people do, because psychologically they feel more comfortable if their money is with different managers. With us, you have 3,000 investments in 23 countries. It's already very diversified. By the way, all of the money that you give us, we never touch it. It goes to the public trust, and it's held in trust for you by them. So we never touch it. So there's very low risk in investing, but the diversification, there comes a point at which is the extra diversification worth the extra fee. And if we thought that we could give you more diversification by charging you the same fee and it would be better, we would do that. In fact, what we are doing now is just diversifying investments within our funds and increasing it even more, like including a little bit of mortgage lending, for example, in there. So I can't answer the question because it's personal advice, but I can tell you that you are very diversified with our funds, and your money is very safe. Yeah. There's a question here. I have $20,000 on my Kiwisaver. I've been with Simplicity for 3 years. Can I get a home loan for $500,000? What you do is, it's really simple. I think we have probably the most efficient mortgage lending system in the country now. Spend a lot of time working on it. Go online, you can get a pre-approval. It will tell you how much that we can lend you. That's within a couple of minutes. You'll get a pre-approval letter straight away. Go out, start looking for a house. But you can find that out within a couple of minutes. It depends on your income, Benson. There's the eternal question here from Sandeep, funds versus properties. Once again, that's a personal issue about whether you invest in investment properties versus funds. I would say this, history has been hugely favorable in terms of investment properties. You've seen the returns, you've seen the tax advantages. To my mind, what's interesting about this now is the pendulum is swinging. Successive governments do not want all of New Zealanders' discretionary savings and investment in investment properties. That is why the bright line test has been extended. That's why they changed the tax offset rules. So I think the playing field is becoming more level. Is it level now? That's like comparing apples and oranges. Investment properties are highly concentrated. They have a lot of leverage on them, but they can return a lot of money. And, you know, in some cases, that can be a low risk investment over time as well. Managed funds are just a completely different beast. So I can't say it's one or the other. It depends very much on your personal circumstances.
There's one here I like from Ben, because only you can answer this. With Simplicity being an infinite company, who's the next good bugger that's going to keep things going for a discounted salary?
There are plenty. We have a succession strategy, folks. I know I'm the public face of the business a long time, but we have 3 people lined up who could take over for me if I got run over by a bus tomorrow. I'm one of only 21 staff and 67 volunteers. It's not that big a deal that I'm involved. I'm no more or less valuable than anyone else. So the answer is there are 3 amazingly good buggers who'll do a better job than I lined up if I got run over by a bus tomorrow. So we think a lot about succession strategy, and we have those plans in place.
Question on Terry about tax, which is basically, I don't know what EET is, but if we can persuade the government to change the tax regime for savings to EET.
EET is exempt tax. So basically what they're saying is that you pay, you save out of your after-tax income, and then the funds are taxed, and then you get the payment, no tax at the end. That's called TTE, and that's how we tax our investments. What this person is suggesting is EET. So you get tax-free contributions, it accumulates tax-free within the fund, then you pay tax at the end. Other countries do it that way. Look, theoretically, that might be a better way to do it, to increase it. The problem is that New Zealand is so hardwired into that way. I don't think that is going to change. It's a nice academic exercise to think that would happen, but I don't think that it will happen in practice, not for a long time. Because if nothing else, the government's got used to the tax revenues, so it's not going to give it up willingly.
Well, here's one for you then, Sam, because this is very much feeds to something I know you like to talk about. If there is a case for infrastructure investment by Kiwisaver funds, are governments trustworthy and competent enough to direct that investment? Who should control that much investment capital?
Yeah, and you might be surprised me to say, yes, I think governments are sensible enough to get people involved in infrastructure investment. And look, it depends where you fall on the political spectrum, right? But the last big time they did that was listing the power companies. Was that a good idea? There's a whole bunch of people who say, no, we would have lower prices as a consequence. but the government did direct it. They did sell off 49%. Lots of funds, including Kiwisaver funds like ours, are invested in those power companies, and you've ended up benefiting from those increasing prices and dividends and so on. So they're perfectly capable of doing that. And of course, the investors like ourselves who would be thinking very long term, we would want terms and conditions from the government which would be beneficial to our investors over the long term. The thing I don't like about most infrastructure investment, and it's, that happens overseas, is they tend to be very complicated structures. They tend to really benefit the investors short term. There's lots of layers of fees and so on and so forth. They're not really long-term investment for funds like ourselves. So if we can work with successive governments and getting some sensible long-term, low-fee type investments, we'd be very keen on that.
Question here from the Allen family. Hi there. There's a lot of talk for some time that the US stock exchange is going to crash because the Fed is feeding money into it to prop it up. Do you agree? If this does happen, this will affect our Kiwisaver. It's been 15 years on the rise. History shows crashes every 10 years. COVID isn't over.
Yeah, so I mean, it's a perfectly legitimate question, and there's a whole bunch of people who are predicting the next financial markets crash, including economists. In fact, I would say that, one joke I quite like is that economists have predicted 9 of the last 3 recessions. So there's always someone out there saying the sky is going to fall in no matter where the market is. And look, they might be right. I mean, it's impossible to know where financial markets will go. The best protection you have against that is a very diversified set of investments, which we have, and you pay the lowest fees, and not panicking when these things go down. Because as the charts I've showed you show, over time, things go up. You get rewarded for taking on the risk of investing in shares. Some of that risk is mitigated by having a diversified portfolio, and you always benefit from fee savings. But yes, if you are passionate about thinking the share market is going to go down, and in the short term, and you're certain of that, and you want to protect your investments, you may well switch into a lower risk fund, or you may take your money out entirely and stick it in the bank. That's not what we do. We invest for the long term, we diversify risk, we charge the lowest fees, and we don't get emotional about when markets go down, because we know that history, and a huge body of history, shows that over the long term, you'll be okay as long as you stay invested. And in fact, you benefit from market downturns when markets turn down if you're investing. Warren Buffett, arguably the greatest investor of our generation, says, I love it when markets go down. I rejoice because then everything goes on sale. And it's true. Yeah.
There's one here from Bryce, which I just want to quickly cover. He says growth fund seems to achieve around 10 to 15%. Well, hopefully, but probably not long term. Many of the financial advisors can do just as much, but they charge a fee. Really don't understand the incentives to use a financial advisor. Keen to have your unbiased view. Understand you are a Kiwisaver provider only. Well, I'll just cover for the last bit. Bryce, we're not just a Kiwisaver provider. We do have non-locked-in funds as well, called our investment funds. So just have a look on our website. But Sam, do you want to comment on the advisors?
Yeah, look, it's like everything with financial advisors. There are good and bad ones, right? So financial advisors, and Andrew and I have managed networks of financial advisors for various businesses over the years, so we have a pretty deep understanding. You have to understand how financial advisors are motivated. There are some people who charge a fee like a lawyer or a doctor to give you advice, and it's impartial advice. They're not paid by any providers. That would be like going to a doctor who charges you a fee and isn't paid by the drug companies, right? So those are the financial advisors that I think generally you can trust. The problem I have with a lot of financial advisors is they work for a commission, which means they get paid by the fund manager who product they sell. So for example, a typical example would be they put you into a Kiwisaver fund and they say, this is best for you. It charges 1%, but don't worry, they're really good. They have to disclose, and they'll do it in the fine print, and they're being forced to now be much more obvious about that disclosure. But often they will be paid 0.25%. So 25% of the fee you pay is paid to them by that fund manager. It's called a trail commission. And in fact, in my opinion, the worst operators will pay up to 0.5%. That is a massive incentive for that financial advisor to keep you in that product, whether or not it's good for you. because they are getting paid money. So I just object very strongly to a financial advisor who should be representing you, acting in your interest, acting independently, getting paid by somebody else whose product they are selling. That to me is wrong. I think commission should just be banned. And the problem is that the life insurance industry makes a fortune out of these commissions. And they lobby the government very hard, saying, if you take away commissions, financial advice will go away. No one will give any advice. I think that's total rubbish. That's like saying, that's like doctors saying, oh, we get paid by the drug companies. If you stop the drug companies paying us, the medical profession will disappear. People will need financial advice. The industry will reshape itself around charging a reasonable fee to you, like a lawyer or an accountant or a doctor does, for the services they provide. So that's my view on financial. That means that there are very, very few financial advisors who genuinely work for a fee, but we are very strongly behind that growing, and we will encourage that as much as we possibly can. Now, there are some really great financial advisors out there, and there are many financial advisors who will rebate all of that fee so they won't get paid by the providers. I think the best first place to go is there's a list now on Money Hub that you can go to, which lists this used to be drawn up by Mary Home. Money Hub's taken over it now. But even then, you should ask each one of those advisors, how are you getting paid? And are you getting paid by any product providers? And if they are getting paid by a product provider, just ask a simple question, yes or no. Are you receiving any compensation from product providers? If they say yes, just walk out. Just don't deal with them. But if they aren't getting paid by product providers, you're much more likely to be getting independent advice. That's obviously just my personal view. Yeah.
No, I very much echo that. There's one here from Connor, and he's actually asked it on both, so I really think we should answer it, which is the theme of prosperity in New Zealand due to Kiwisaver applicable to the whole world? How many other countries have Kiwisaver-like schemes?
Yeah. Great question, Connor. Yeah, and the answer is generally yes. If you have a look at the OECD countries that have prospered, look at the countries that, and there's lots of exceptions here, folks, so just please don't shoot me down because I'm sure there are exceptions. But as a general rule, my view is this. If you look at very successful countries where, people want to live and where there's a higher quality of life, they have two components to them. One is their democracies. Democracy tends to be a pretty good, I mean, as Churchill said, democracy is the worst form of government except for all the others, right? And the second one is they generally have saved a lot of money. So the OECD countries that are wealthy are Scandinavia, America, Canada, Europe, Japan. All of these countries tend to have very, very large superannuation savings, and they get invested back into the economy. So it is a theme in the most successful countries in the world, or the most prosperous countries in the world, with obviously exceptions. And so, yes, it is a theme, and it's something where New Zealand is playing catch up, but thank goodness we are.
There was one here. Actually, this one I think is very interesting. I'm not sure who it's from, but it's from Facebook. What key experience has driven your current sentiment towards finance and investing?
So what key
experience has driven your current sentiment towards finance and investment?
Oh, right. Okay. So, yeah, well,
the why.
Look, I'll speak personally. I am what we call a gamekeeper turned poacher. So I used to work for the biggest financial institutions, but I come from Sunnyvale and West Auckland. I didn't like the fact that I was making myself wealthier, but not my whānau or the people around me or in my neighbourhood wealthier. I thought the finance industry was increasingly like ripping off New Zealanders in terms of high fees. So I was very lucky. I had a very lucky career. I was able to be in a position to become a volunteer and set up Simplicity. And along with a team of fantastic people, my partner and Andrew and a whole bunch of other people who got in behind, and just honoured to be part of that group. So that was my motivator, which was actually, and it, when you want to make a difference in the world, I was planting native trees for a while there as a volunteer. But I realized, look, you've got to make the biggest difference. And so the finance industry is the most profitable industry. It's, as it were, the biggest sandpit you can get involved in if you want to make a difference. And so that's what we're doing. What was your motivation, Andrew? Because you were there from day one too, mate.
Yeah, I think when you've worked in the financial market, I can remember saying very, very early in my career that I spend my time making more money for people that have got too much already. But I just never really got the opportunity to do something worthwhile. And I think your experience and your comments when we first met to talk about setting Simplicity up resonated very, very, very clearly. And I mean, you know, we're enjoying ourselves. It's great to have a committed bunch of people working with us, and to to feel like we're doing something good. So there is a sort of a self-fulfilling piece of this too. But fundamentally, it's just great to be able to use the knowledge that we've gained over quite a long time of being involved in this thing to improve things for people that don't know what we know.
Could I just, Andrew, could I just say something about Sir Michael Cullen there as well, because he just died and I've just been thinking about it. He was one of the people that I first contacted when I wanted to set this up, and because he was the father of Kiwisaver. And I said, look, I've got this idea, what do you think? And he said, go for it. And he was one of the really great early sort of inspirations for me. History is a tough judge on politicians, but I have to say Sir Michael Cullen is the first of what I call a three-peat of fantastic finance ministers we've had in this country. Michael Cullen, Bill English, and now Grant Robertson. And regardless of where you sit on the political spectrum there, I don't think any other country in the world would trade their last three finance ministers for our last three. They've just been fantastic on both sides of the house. I think Michael Cullen's great legacy in life will be Kiwisaver. He had the forethought to set it up when he was, I understand he was advised against it, but he did it anyway. And it has been the most successful financial product in a generation. It will fuel a whole new economic renaissance in New Zealand. I'm pretty convinced of that. I think it already is. I think part of our economic success so far has been even what that $82 billion has started to do in terms of being recycled in the economy. So he's just, well, he's a bit of a legend for me, Michael, and a mentor at important times of simplicity. So we're going to really miss him. He was, I'm very sad about that.
Yes.
Any other questions, Andrew?
Okay, so again, still many. There was one that's come through here, which is, could you answer Gareth's question on investing across more than one investment company? I think we did. So if we haven't, the point there is that we are as diversified as we possibly can be. You don't need another manager. If you go to another manager, you might get a different style if you prefer, but that's not going to diversify your investments. Sorry. One actually a very quick one here from Susie. Why did you move the NZ share fund to 35 companies from 49? That's a really interesting question for those that really interested in that sort of thing. We actually changed the index we're monitoring. We're monitoring something called the Morningstar New Zealand Index now, which just represents the top 97% of the market cap. The NZX 50 is just 50 stocks, and right at the tail of that, some of those companies are, by the stock market standards, quite small. And we've already found that as our funds have grown, that actually buying the index, buying the total, the all 50, it was becoming a little difficult. We changed the Morningstar index because it doesn't get changed so often. It's a very, very stable set of constituents. And what we found already is that, again, as we've grown, buying those companies that are down in the bottom 30, the 35th, 36th, 37th, actually, we've got to be very careful because we can't buy enough of them. There's just not enough liquidity at that end of the market. And so if we were still buying all 50, of course, we do screen out 3 stocks as well, Sky City, Genesis, and Delegates. So even if we're buying the 47, it just is so hard to deal in the New Zealand market when you're dealing with those smaller stocks. So although the reason for moving to this different index wasn't the reason. The reason was because it's a more stable index, but it actually has worked out that otherwise we would be really struggling to actually implement the index tracking that we want.
Thanks, Andrew. Can I just address a common one here about home ownership, impending home ownership for people? This is from an anonymous person. Good morning, great presentation. I'm 26. I cannot afford a house currently, but it's probably on the horizon in the next 3 to 5 years. I have a lot of cash on hand, which is being saved for this future house. Inflation is burning cash. So where is the best place to put the money or a portion of this? This is a really big issue for a lot of people, right? Because the temptation is to want to put it into growth assets to keep up with either house price inflation or make it grow as much as possible so it can be a deposit. It's a very personal thing, this. But I would say this, normally, as you said, most of my presentation has been about taking on more risk and so on over the long term. But if you need to buy a house in the next 3 to 5 years, that is short term. Financial markets can go down in that time and stay down for a while as well. So, and this is not personal advice, please don't take as that, but I would just say, think about this, that you need that amount of money as your house deposit. And you cannot, most people generally cannot afford to lose that, because if in losing money in the short term means they can't get into a house, that's a much bigger deal, right, than the extra money you may have made in a short period of time by taking on more risk. So for most people, I would say if it comes to that house deposit, you need to be fairly conservative if you're getting close to the point at which you're about to buy that house. The most important thing is buying the house, getting the house. And so therefore, the risk of losing money on that deposit at that important part of your life, that can have a much bigger effect on, you know, your short to medium term outlook in terms of being in a house or not. So I tend to advise, sort of general advice is that to be pretty conservative about how you treat your house deposit money if you're going to be buying a house in the next few years. If it's a 10, 20, 30-year thing, you can afford to take a much longer term view.
Great. There's one here which I was intrigued to have a quick look at, and about that slide you show, Sam, where you've got all the markets in the world, the asset classes, and the colours move up and down the chart. I can't find the question now here, but somebody said if you actually look, the New Zealand equity market, yeah, there it is. From Steve, one of the slides, the New Zealand equity appeared at or near the top in nearly all years. What are your thoughts on investing in a diversified New Zealand equities portfolio rather than balancing New Zealand allocation with the worldwide? Yeah. So all I would say is that I've had a quick look at the slide just to see, and I thought that too. New Zealand equities on balance have performed relatively well compared to many others. But if you actually look at you can't see it on that slide, unfortunately. If you look at the actual return generated, very often the slides at the top, or the asset class at the top, are much, much higher returns than the New Zealand equity return that year and any others relatively. So you need to have a bit of everything. That's the point, that you want to have global equities, you want to have New Zealand equities. We have more in New Zealand proportionately than we would do if it was just done on a GDP basis. In fact, we'd have almost nothing in New Zealand if it was just done on GDP. So we are relatively overweight New Zealand compared to what we would be from a, if you like, purely economics point of view. And that's because everybody's risk is basically in New Zealand. So there's a bias towards wanting your assets in New Zealand. But the key point to that whole slide, Steve, is that you want diversity. You're going to have a bit of New Zealand, but you want to have some of the ones that are at the top of the chart every year as well. There is a very quick one here from Gareth. Plans to offer first-home loans on apartments in freehold. Actually, Gareth, we haven't made the policy yet, but we are investigating that. We do realise that that's for first-home buyers, that's an area that they are likely to be involved with. Riona suggests we should all have a pay freeze because the government's frozen salaries for 3 years. Thanks for that, Riona.
Well, actually, I'll address that because I think that's a fair point. They're saying, are we going to have a pay freeze? Obviously, Riona, we have had, so we haven't put up our pay so far. If things go well for us and better, what I would like to do is to make sure that the people who are paid lower amounts at Simplicity get looked after. You know, they're like everyone else, right? They want to get ahead in life and buy a house and so on and so forth. So they'll be looked after first. And then I cannot imagine, Andrew, that people like you and I are going to do anything other than work for below market rates forever just because we love it so much and it's the right thing to do. So, and we can afford it, which is kind of nice too. So, look, I won't be committing to any sort of pay freezes or anything like that because we want to keep our staff well motivated. But I can assure you that they're working not primarily for love. They're working for great purpose in that, and we pay fairly. Yeah.
I've got one here from Doug, and it's something which comes up occasionally, and I'm interested to hear your answer to this, Sam. So we've had a $250,000 investment in the Simplicity Conservative Fund for 12 months. Our return has been way less than inflation. We notice that Simplicity is making donations to charitable causes. We believe that we should make such donations ourselves. Why don't you stick with your core business and make wise investments and leave your investors to make donations themselves?
Fair enough. So, and that's a perfectly fair question. So first of all, I don't think it has performed below inflation. I don't know what the return over the last 12 months is, Andrew, but I think the Conservative Fund has consistently tracked above, and will certainly over the long term consistently tracked above inflation. So in the sense that inflation is running at, it's, somewhere between 1% and 2%. So it's certainly been returning higher than that. But the point you make about charitable donations is a perfectly fair one. We choose to give 15% of the fees you pay to charity. That's what we do. I would say this, first of all, is, of course, you have the choice to move to another provider if you think you can get higher returns and pay higher fees. That's totally cool. You can move straight away. But what I would say is this, is in giving 15% of fees to charity, that means we get a lot of services provided to us for nothing. For example, we have 67 volunteers in this business, and I don't just mean people running sausage sizzles. These are lawyers, accountants, PR people, and so on. And the vast majority of people working for Simplicity, because we give 15% of our fees to charity, are working for purpose, and therefore they probably work for lower salaries than they were if we did it differently. So I actually think that members actually end up making a significant amount more money as a consequence of us being a charity, a social enterprise. What we save is way more than we give to charity. And the third thing is, look, that's just how we roll. That's our business model. That's what we do. And I totally understand if that's not for everybody. If someone else wants to move their money to a higher fee manager and then pay the extra money to charity themselves, by all means, they should do that. I think it's important for us to poll our members and understand what their priorities are. So we've done that several times now, and we make sure that the donations are falling in line with their priorities, which are children in need, the environment, financial literacy, and the homeless. So we tend to focus the donations around that. But totally understand it's a free world. Everyone has a choice to do it that way. That's how we roll. We know it is financially beneficial to members in terms of lower fees than they would otherwise pay. But I understand it if you disagree with that philosophy. Yeah.
One of the problems we have now is I'm not sure if everybody's still on the call that's asked the questions. There's a question here from Cameron. If I'm already contributing to Kiwisaver and I already get the government and employer contributions, but now have an extra $1,000 to invest each month, is there any benefit to putting that $1,000 into a Kiwisaver fund versus one of your outside Kiwisaver investment funds? The answer, Cameron, if you are still there, is that actually there's no benefit to it being in Kiwisaver, and therefore you've got more flexibility if you keep it outside of Kiwisaver. It's very simple in that the funds are exactly the same. So our non-Kiwisaver investment funds are managed in exactly the same way as Kiwisaver. They perform very similarly, slight differences in cash flow, but fundamentally they perform very similarly. And therefore, if you want the flexibility of being able to use your money when you want to and not just when you're 65, to keep it outside of Kiwisaver. I'd like to open a Kiwisaver account for nieces and nephews. I don't want their parents to know. You can't have two accounts. Unfortunately, you can't do that, Heather. The parents have to know. In order for the account to be open, the parents have to provide birth certificates and their own ID. It's just one of the restrictions. So unfortunately, I'm sorry, you can't do it. You can, of course, you could possibly set up an investment account outside of Kiwisaver, but I'm not even sure there that you can do that without the parents' permission. Sorry.
Can I just ask, there's one here from Jeffrey. I have a significant amount invested with a managed fund company. I'm slightly regretting this decision as the fees are greater with them as well as the brokerage. My initial thought was that I didn't want to have all my eggs in one basket as I have a Kiwisaver as an investment fund with Simplicity. Your thoughts? Jeffrey, I'm sorry, I can't give you personal advice here, but I would say this. The diversification that you get by having other managers in some cases is a good idea. In some cases, as maybe in your case, you just end up paying more fees for approximately the same diversification anyway. I would say this. I believe in eating our own cooking, so I have all of my discretionary investments with Simplicity, just in my Kiwisaver growth fund. I feel incredibly comfortable that that is diversified. That is my retirement there, and I think it's really important philosophically that I invest all of my money the way I would want, we're asking you to invest some of your money. But if that gives you any more degree of comfort, I'm really comfortable with the diversification there. I'm really comfortable with the way it's managed. And, I go to sleep at night knowing, very comfortably knowing that Andrew's looking after the money.
Okay. So here's one from Brendan. It's quite specific, and I'm not sure how you want to answer it. I know the answer, obviously. Does Simplicity have any debt?
Yeah, sure. No, that's a very good question. The answer is we do, a small amount. So how Simplicity was funded initially was I sold my batch to fund it, and that was provided in the form of a zero interest rate debt, which means that if Simplicity was successful, I would get repaid. If it wasn't, I would have lost the money. Then that debt was actually taken over by Sir Stephen Tyndall. This is all very public, it's all public. He took over the debt, he repaid me, which was very nice of him because he wanted to help out. So he, and we have been paying off that debt. That was initially $1.5 million. We've now paid it down, and I think we owe $250,000 now. That will be paid off in 2 months, and then we'll be debt free. And in fact, we what we call net tangible asset, NTA positive, next month. That means we would have basically paid off everything that then in Simplicity will be, worth something, as it were, have a positive value. And then at that point, then we can start thinking about lowering member fees again. We have lowered member fees 4 times, even though we've been paying off debt. But now we're in a financially a very good position now where we can pay off all the debt and think about lowering members' fees. And then, of course, as we get more economies of scale, we will continue to lower fees, and of course, we will continue to give more to charities. So there's a very virtuous circle here. We manage $3.6 billion now, but remember the size of the market we're getting into now is going to be a $400 billion market by 2030 in 9 years' time. So we can afford to be, we will hopefully get a lot bigger in terms of scale, and therefore we will be able to pass on a lot in terms of fee savings.
Yeah, there was an earlier question, and I can't think who it is, and I won't screen all the way back, from somebody talking about the actual wholesale fee rates for things like Vanguard funds in places like the UK and the US, which are significantly lower than here. And whoever you are, you're absolutely right. Relative to the sort of money they're talking about, 0.3% per annum is relatively high. However, as our expenses become a smaller and smaller proportion of the overall revenue, so we will be able to drive those fees down to close to overseas levels.
So to give you an idea, the market generally charges about 1%, a little under 1% for most of these managed fund fees. We charge 0.3% or 0.31, so a third of what the market is charging at the moment. We think that is too high. We agree with you. That should come down even more. We're never going to get to the point where we charge the same as Vanguard running a multi-billion-dollar wholesale fund with very few investors, with very light regulation. It's never going to happen. But we will get it down to a point where it is, pretty damn close to those numbers, because we have a business to run, right? There are customer services people to look after. There's a regulatory environment. Although we have, an office, we have to fund all that sort of stuff. But suffice it to say, we're not going to be making any money. We're a non-profit. So we will pass on the benefits of scale to members. We will continually set the benchmark for what you can do and how little you can charge for it.
Yeah, absolutely. Question from Kit. We are 70. Should we switch from Kiwisaver to your other funds? Actually, Kit, you're in the fortunate position of not needing to. There's no difference for you. You can, once you've made your first withdrawal, there are some hoops to jump through for that. But once you've done your first, you can treat Kiwisaver just like our investment funds, because you're over 65. So there's no reason to switch. As I say, there are some paperwork you'll have to do for your first withdrawal, but you'd have to do that anyway. So that's the only one. There's a question here, hopefully you know who you are, because I don't understand the question. I'd like to answer it. Is there any downside in my fund's value when I switch funds from managed funds to Simplicity?
I think that's about that. There are no switch fees. You can go from managed funds into Simplicity. Well, if it's from another fund manager, they shouldn't charge you a fee to take the money out, and you can put it in, so they shouldn't lose any value. If you're going from Simplicity investment funds to the Kiwisaver funds, and there's no cost. You're just going straight from one to the other. Yeah. There's another one which is kind of interesting here, but besides just lowering fees, can we also look into an attractive home loan model for first home buyers? We've already got it. So if you go into our home loans for first home buyers, we have a 1.9% floating interest rate, the lowest in the market by far. And it's available to all Simplicity members who are buying their first home.
Okay, I'm just scrolling through.
I think we've just about run out of questions, Andrew.
We've got there, unless somebody comes up with anything now. Thank you all for your positive comments on the chats, etc.
And folks, if you want to know anything, if we haven't answered your question, we apologise. But if you wanted to, just send us an email to info@simplicity.kiwi. Our customer services people will trawl through these questions and just try and get the answers to you if you can provide any contact details, but probably best just to copy and paste it, send it to us at info@simplicity.kiwi. And if you'd like to have a chat, just ask them for me to give you a call, and just give us your number and we'll give you a call, and we just want to help. So thank you very, very much for coming along. Is there anything else, Andrew?
Well, no, there's just a comment there from Nate, who's obviously got a, I don't know, some sort of. Will you do another session at 1:30? I think is it 1:30 or 1?
1:30, yeah.
1:30. So Nate, if you really want to sit through this again, be our guest.
And yeah, folks, this will be the same presentation as it was this time, so there won't be anything different, but obviously the questions will be different. But
so Nate, sorry Nate, I've just got your second question. So yeah, so we're starting again at 1:30, so you get to do the whole thing from the start.
Yeah. So folks, thank you very much for joining. We had about 500 people on the call, which is fantastic. Thank you so much for those of you who are Simplicity members. And just a final request, we don't spend too much money on marketing. Actually, we've got our first sort of marketing campaign just coming out right now with Grizz Wiley and the All Greys, but we don't spend, we spend a tiny fraction of what our competitors do on marketing. So if you like what you hear, if you could just do us a favor and just talk about us, word of mouth is just the very best. So thank you very much for joining us. Thank you very much for being members, and we'll see you soon. And get in touch if we can help in any way. Thanks.